What events will you be basing your trading strategy on next week? Well, here's a quick wrap-up of the top economic calendar events for November the 21st to the 25th. Now, Wednesday the 23rd is the main day in focus next week and will be an interesting day, particularly for the US dollar and the pound. The FOMC chair Janet Yellen hinted at an imminent interest rate hike at her speech before the Joint Economic Committee on Thursday, triggering a supplementary relief rally in the US dollar against the majority of the G10 and the emerging market currencies. Now, Fed action in December is now seen as almost granted, and the November FOMC minutes due on Wednesday should only reinforce the Fed hawks camp. As the market is almost convinced that the Fed will raise its interest benchmark rate, investors are now pondering over another key element, the steepness of the Fed's policy. How many rate hikes should be expected in 2017? Well, as of today, LCG senior analyst Ipek Ozkardeskaya believes 2 to 4 rate hikes would be reasonable, depending on how many of Trump's promises will go through the line. But before the FOMC minutes take centre stage, the UK autumn statement on Wednesday will be closely watched by traders due to its likely influence on the pound and UK stocks. Now, the autumn statement will be Philip Hammond's debut as Chancellor and the first since Theresa May became Prime Minister after June's Brexit referendum. Now, the new Chancellor will reveal his first macroeconomic forecast and will need to take into account the Brexit impacts on growth and public finances. This could well be read as a renewed downside risk for the pound and the most Brexit-sensitive UK stocks, such as the banking and real estate sectors. Let's take a quick look at the pound dollar. Cable failed to extend gains above the Friday 11th post-flash crash peak. The broad-based appreciation in the US dollar dented appetite for the long pound positions, and the lack of conviction is here to stay before the critical autumn statement. Now, the 50-day moving average, the 1.2495 mark, has acted as a solid support over the week to November 18th and is expected to shelter offers in the autumn statement. Following Wednesday's statement, the UK will release the second estimate of third quarter GDP data on Friday morning GMT. Now, the first estimate showed that UK Q3 GDP grew by 0.5%, beating forecasts for 0.3% growth, albeit slower than the 0.7% recorded in the second quarter. This was driven by a strong performance in the dominant services sector. However, the industrial production, construction and agricultural sectors were all weaker. Now, many economists are still expecting growth to slow over the next few months due to rising inflationary pressures and weak earnings growth, mostly caused by the plunge in the value of the pound and Brexit uncertainties in the UK's business environment. Finally, Japanese inflation figures will hit the wires on Thursday the 24th. Now, the yen has benefited from the sharp rise in US yields to extend losses. The dollar-yen traded above the 110 level as the Japanese 10-year yield crossed above 0% for the first time since September. In other terms, the Fed-induced global rally in yields tremendously helped the Bank of Japan to achieve one of its critical promises, keeping the 10-year yield around the 0 level. Hence, the BOJ's credibility benefited from a good lift, and the recent development should support further yen depreciation against the US dollar. The dollar-yen is expected to target the 112.50 area in continuation of the current positive trend. The midterm target stands at 115. That's all for now, folks. Now, don't forget to follow us on social media. Follow us on Twitter at LCG Trading and at London Capital Group on Facebook. Goodbye for now.